For late 18th century Britain, global commerce was the unquestioned lifeblood of the empire. This sprawling trade network and the naval dominance required to protect it traced its roots straight back to Queen Elizabeth. At the tip of this spear was the British East India Company. After decades of struggle, their massive merchant ships were finally returning extraordinary wealth from across the globe, giving shareholders their first real prospect of a highly profitable return. But success attracts hungry eyes. The British government, nursing a severely depleted treasury, stopped viewing the company and its colonies as strategic partners. Instead, they began treating them as a quick fix, a financial piggy bank to balance the state's books. The first warning sign was the Stamp Act in the American colonies. Looking at contemporary records, critics noted how this tax drained the colonies of the hard currency they needed to actually buy British goods. The government risked crippling an entire colonial economy for a minor short-term boost to the exchequer. Then the ministers turned their sights on the East India Company itself. The Chancellor of the Exchequer issued a direct mandate freezing the company's dividends. The government effectively took the company's profits hostage, forcing proprietors to surrender over half their earnings to maintain control of the assets they had built. By micromanaging corporate balance sheets to cover state debts, the British government faced a harsh economic reality. They had to decide if heavy-handed political intervention would save the national economy or destroy the very trade it was trying to exploit. To see how dangerous intervention can be, we need to look back to the early 1600s. The Dutch realized early on that a free-for-all approach to global commerce was disastrous. Competing merchants from Amsterdam and Zeeland were fitting out multiple ships for the exact same ports, driving down the value of their own goods and ruining their profit margins. The Dutch government, the States General, intervened with a highly specific strategy. In 1602, they forced these competing factions to unite into a single corporate entity, granting them exclusive trading privileges. This created what we can call the autonomy model. The state provided robust military protection for the company's overseas assets, treating them with the same fierce defense as national territory. Crucially, though, the state built a strict barrier between the company's profits and the national treasury. The government never claimed the company's wealth for public use. The results were staggering. By respecting private property and refusing to siphon profits, the company thrived, paying annual dividends averaging over 24% for 16 consecutive years. The wealth generated by this system wasn't theoretical. Artifacts like this 18th century copper VOC coin are physical proof of an enterprise that held absolute sovereignty abroad while maintaining total financial independence from the politicians at home. The Dutch dominated global trade for over a century precisely because their leaders had the discipline to treat corporate profit as a protected national asset rather than a taxable target to be raided. France attempted a wildly different approach. Across the 17th century, French absolute monarchs operated under the assumption that global trade could be commanded into existence through sheer political authority. Starting in 1604, King Henry IV established a French East India Company by royal decree, which quickly failed. King Louis XIII tried again a few years later with the exact same result. The definitive test of this state-run approach came under Jean-Baptiste Colbert, the powerful minister to Louis XIV. Colbert meticulously planned a new company, injecting massive state funding and royal privileges into the operation. But Colbert's company was poisoned from the inside by what we'll call the ministerial model. French ministers constantly prioritized the immediate demands of the royal revenue over long-term commercial growth. They repeatedly altered laws, abridged the company's privileges, and squeezed the operation to fill the king's coffers. By 1712, the state-run company was bankrupt and 10 million livres in debt. In a final desperate move, they rented their remaining privileges to private merchants from the town of Saint-Malo. Operating far from the royal court and completely free from ministerial micromanagement, these private traders quickly turned a massive profit. Despite seeing clear evidence that autonomous trade worked, the French state couldn't stop interfering. In 1719, the government annulled all privileges, absorbed the entire East India operation into a sprawling, debt-ridden national paper money scheme known as the system, and drove it directly into total ruin. France poured immense wealth and absolute political power into capturing the East India market. They failed repeatedly because the government prioritized short-term financial extraction over long-term commercial independence. Which brings us back to the late 18th century, with the British Parliament standing squarely at the intersection of these two historical paths. They could choose the Dutch route to prosperity or the French route to ruin. England actually began on equal footing with the Dutch. In December 1602, Queen Elizabeth granted an exclusive charter to a group of merchants trading to the East Indies. Fueled by early profits and permanent charter rights, the English merchants rapidly scaled their operations. They financed a 1,200-ton vessel, the largest ship ever built in England up to that point, effectively kickstarting the nation's naval dominance through private enterprise. Yet the English crown historically faltered where the Dutch excelled. While the Dutch provided unyielding military backing, early English monarchs often left their merchants to fend for themselves abroad. Without state support, the early English traders lacked the force required to secure their share of the vital spice trade. Now, decades later, the situation has flipped entirely. The company has finally secured profitable footing on its own, and the British government has suddenly rushed in, acting exactly like the French. They are aggressively interfering with internal management and holding company capital hostage. Subjecting a trading corporation to the arbitrary whims of a chancellor creates immediate panic in the market. Proprietors are forced into a defensive crouch, deliberately sacrificing large portions of their hard-earned profits simply to appease the politicians and avoid total state takeover. History offers a brutal and consistent lesson for managing global empires. True national prosperity requires granting exclusive commercial rights and providing rigorous external defense. But above all, it demands a government that possesses the supreme political wisdom to stay out of the way.